Today, we will begin putting supply and demand together in the market so that we can characterize the equilibrium outcome and begin analyzing how changes in economic conditions affect the equilibrium outcome. By the end of today's lesson, you should be able to do two things. First, you should be able to solve for the equilibrium outcome in a competitive market. Second, you should be able to predict what will happen to the equilibrium price and quantity as a result of changes in underlying economic variables. Some examples of economic variables whose effects we will study are income, the prices of other goods, and government policies. Let's start by defining what we mean by equilibrium in a competitive market. If a market is in equilibrium, then nothing is changing. In particular, the market price of the good is not changing. With that definition in mind, let's build up our model of a competitive market and see if we can establish what an equilibrium would look like. Generally speaking, perfectly competitive markets contain many buyers and sellers, all of whom are price takers. There are no barriers to entry, which means that it is possible for anyone who wants to participate as a buyer or seller in the market to do so. These criteria establish the minimum requirements for a competitive market. Typically, we also assume that the good being traded is homogeneous, and all the information about the quality of the good is common knowledge among the market participants. We also assume that there are no externalities. That is, we assume that all the costs and benefits of producing or consuming the goods are captured by the supply and demand curves. We will start to examine what happens to market outcomes if we relax some of these assumptions in the upcoming weeks. To build up our market model, we start with the market supply and demand curves. Note that since we are graphing price on the vertical axis and quantity on the horizontal axis, we are actually using the inverse supply curve and the inverse demand curve. For simplicity, however, we will delete the word inverse in the discussion that follows. As you studied previously, we get the market demand curve by summing the demands of all the individual consumers in the market. Similarly, the market supply curve is generated by summing the supply curves of all the individual firms in the market. Note that since the supply curve is upward sloping as opposed to horizontal, we are looking at a short-run market supply curve. Now that we have our market established, we can start to characterize what market equilibrium will look like. Let's start by considering possible equilibrium outcomes in our model. Note that if we discover that at a particular outcome there are forces that will cause the market price to change, that particular outcome is not an equilibrium point. First, consider a case like the one pictured in this graph. At this price, the quantity demanded is greater than the quantity supplied. Because more consumers want the good than there are units available, these consumers are willing to pay more and bid the price up. Because there are forces present which will cause the price to rise, this price is not an equilibrium outcome. Similarly, at this second price, quantity supplied is greater than quantity demanded. At this price, not all suppliers will be able to sell their product. Some of them will have an incentive to mark down their prices, causing the market price to fall. Therefore, this price is not an equilibrium outcome either. Using this logic, we can see that the only point at which there are no forces that will cause the market price to change is the point where the market supply and demand curves cross. This is the market equilibrium, where quantity supplied just equals the quantity demanded. To find the market equilibrium, simply set the equations for the market demand and supply equal to each other, and solve for the equilibrium price. Then substitute the price back into either formula to find the equilibrium quantity. If instead you have the inverse supply and demand equations, set the equations equal to each other and solve for quantity. Then substitute this quantity back into either equation to solve for the price. In order for the equilibrium price to change, some variable underlying either the supply curve or the demand curve, or both, must change so that the entire curve changes. For example, if income increases and the good is a normal good, then demand for the good will increase and the demand curve will shift to the right. After the market adjusts to this change in demand, the equilibrium price and quantity will both be higher. Note that in this analysis, we are simply comparing two snapshots in time, one before the change in demand and one after. We are not tracing out what happens in the market in the time between the old and new equilibria. If we were, we would be conducting a dynamic analysis. An analysis in which we look at snapshots in time before and after a change is called a static analysis or comparative statics. If demand decreases, say because the price of a substitute good has fallen, then the demand curve will shift to the left and the equilibrium price and quantity will be lower. If supply increases, say because more firms enter the market, then the supply curve will shift to the right. In this case, the new equilibrium quantity will be higher and the equilibrium price will be lower. Finally, if supply decreases, for example because the price of an input rises, then the supply curve will shift to the left. At the new equilibrium, the quantity will be lower and the price will be higher. Sometimes, market forces act to shift both curves at once. In the cases of both curves shifting, one variable will always be indeterminate. The outcome will depend on which curve shifts by more. For example, if both supply and demand increase, then we know that the equilibrium quantity will increase. The effect on price, however, will depend on which curve shifts by more. Similarly, if both supply and demand decrease, the equilibrium quantity will decrease, but the effect on price is unknown without knowing which curve shifts by more. If supply increases and demand decreases, then the equilibrium price will definitely fall. However, the effect on quantity depends on which curve shifts by more. Finally, if supply decreases and demand increases, then the equilibrium price will rise, but the effect on quantity is unknown. This concludes this presentation of conducting comparative static analysis with competitive markets. You now have the tools that you need to analyze the effects of changes in market conditions on market outcomes, including the effects of government policies, which we will analyze in our next lesson. Today, we will use the tools of comparative static analysis to analyze the effect of taxes on markets. By the end of this lesson, you should be able to analyze the effects of alternative government policies on market outcomes, calculate the deadweight loss from a tax, and explain what it means for an outcome to be Pareto efficient. In class, we will practice analyzing the effects of a tax or subsidy on a market and discuss the ethical implications of using Pareto efficiency as a criterion for assessing a market outcome. There are two main types of taxes, a quantity tax and an ad valorem or value-added tax. A quantity tax is a tax that is a fixed amount per unit purchased. An ad valorem tax is charged on the total amount you spend on the good. The best example of a quantity tax is the gas tax. The best example of an ad valorem tax is the sales tax. When using graphical tools to analyze the effect of each tax on a market, you shift the supplier-demand curve to analyze the effect of a quantity tax. To analyze a value-added tax, pivot the supplier-demand curve. When we analyze the effect of a tax on a market, we want to answer several questions. First, who ends up bearing the financial burden of a tax? We call this the economic burden of the tax. The people who bear the economic burden of a tax may be different than the people who are actually legally responsible for sending the check to the government. Those people bear the legal burden of the tax. For example, in the case of both the gas tax and sales taxes, businesses are responsible for collecting those taxes and sending the money to the government. However, for the most part, both gas stations and retailers pass these taxes straight on to consumers in the form of higher prices. So it is consumers who bear the economic burden of these taxes. The second question we might want to answer when analyzing the effect of taxes is, what is the effect on the market? How much does the tax change the market price and the quantity sold? How much are consumer surplus and producer profits affected by the tax? What are the costs to the economy of the tax, and what are the benefits? Are the benefits worth the costs? When analyzing the effect of a tax on a market, the important thing to remember is that the tax generates a difference between the price that buyers pay and the price that sellers get. The difference between these two prices is the amount of the tax. For a quantity tax, either shift the supply curve up by the amount of the tax to reflect the fact that sellers' costs increase by the amount of the tax, or shift the demand curve down by the amount of the tax to reflect the fact that the tax essentially subtracts from buyers' willingness to pay. If you shift the supply curve up, then the new equilibrium price, which is the amount that consumers pay, is at the intersection of the new supply curve and the demand curve. However, the price that suppliers get is less because of the tax. Sellers get this price minus the tax, which you find by drawing a line straight down from the new equilibrium point to the original supply curve. To find the equilibrium after tax quantity, go straight down to the quantity axis from either price. The other way to represent the effect of a quantity tax on a market is to shift the demand curve down by the amount of the tax. The new equilibrium price that producers get will be at the intersection of the new demand curve and the supply curve. To find the price that consumers pay, go up from this intersection to the original demand curve. To find the after-tax quantity, go down from either price to the quantity axis. Whether you analyze the effect of the tax by shifting the supply curve or the demand curve, the result in terms of the price consumers pay, the price sellers receive, and the after-tax quantity is the same. After you have determined the after-tax equilibrium quantities and prices in a market, you can begin to examine the effect of the tax on the costs and benefits to various members of society. First, note that before the tax, consumer surplus is the yellow triangle pictured in the graph. Producer profits are the area below the price and above their costs, which are represented by the supply curve. Thus, the blue triangle in this graph represents producer profits. After the tax, the price that consumers pay has risen, so their consumer surplus is smaller. Because the price that sellers get is lower, their profits are smaller as well. The government gets some of this surplus as tax revenue, which is the number of units sold times the amount of the tax. This is the orange box in the graph. So far, most of the benefits that existed before the tax are still present. It's just that some have been redistributed from buyers and sellers to the government in the form of tax revenue, which presumably is being given back to consumers in the form of government goods and services from which they benefit. For example, the gas tax helps pay for roads. However, there is one small triangle which no one is getting. These benefits are simply gone and are the result of the fact that some buyers and sellers are priced out of the market as a result of the tax. This loss is called the deadweight loss and is a measure of the inefficiency generated by the tax. The analysis is the same if you shift the demand curve instead of the supply curve. The consumer surplus is the area below the demand curve and above the price that consumers pay, which includes the tax. Sellers' profits is the area above the supply curve and below the price that sellers get, which does not include the tax. The tax revenue is the amount of the tax times the new equilibrium quantity, and the deadweight loss is the benefits that were lost because some buyers and sellers were priced out of the market by the tax. In the previous analyses, the tax burden was more or less evenly split between buyers and sellers. You can see this because the pre-tax equilibrium price is roughly halfway in between the price that consumers pay and the price that sellers receive. So, consumers are paying the top portion of the tax box, and sellers are paying the bottom portion. These two areas are roughly equal. In general, who bears more of the economic burden of a tax is going to depend on the relative elasticities of supply and demand. To see how the relative elasticities of supply and demand affect who bears the economic burden of a tax, it is useful to consider the extreme cases. If supply is perfectly inelastic, then sellers will end up bearing the full economic burden of the tax. To see why, shift the demand curve down by the amount of the tax. Consumers will still pay P0 for the good, but suppliers will only get to keep P0 minus the tax. Thus, sellers will end up bearing the full economic burden of the tax. Note also that because the quantity sold does not change, there is no deadweight loss in this case. The other extreme is perfectly elastic supply. In this case, sellers will be able to pass on the entire amount of the tax to consumers. Note that this is the case that corresponds to long-run equilibrium in a perfectly competitive market. The supply curve shifts up by the amount of the tax, and consumers bear the full economic burden of the tax in the form of higher prices. In this case, there is a deadweight loss because the equilibrium quantity falls. The deadweight loss comes from the fact that some consumers are priced out of the market, and because there are fewer people willing to pay the after-tax price. In the long run, some sellers will exit the market. Thus, although in the short run sellers might bear some of the burden of a quantity tax, as the market reaches long-run equilibrium, the full amount of the tax will be passed on to consumers. In general, whoever is less elastic will end up bearing more of the economic burden of a tax. When analyzing market outcomes, one criterion that we can use to compare different outcomes is the criterion of Pareto efficiency. An outcome is defined as Pareto efficient if, at that point, it is not possible to make someone better off without making someone else worse off. If, at a given outcome, it is possible to make some people better off without making anyone else worse off, then the existing outcome is not Pareto efficient, and there are potential Pareto improvements that we can take advantage of. Note that Pareto efficiency is only one criterion we can use to compare outcomes, and there may be others that are more appropriate for ethical or other reasons.